Our first guest is Milton Jennings, and Milton is the CEO of Fidelity Life and has held that position since 1986. And during his tenure with Fidelity, assets there have grown from 145 million to 800 million. Milton was involved with the purchase of Lumley Life and Farmers Mutual. He's also very heavily involved in the Leukemia and Blood Cancer Trust. Please, ladies and gentlemen, can you welcome Milton Jennings?
Thank you, Carol, and it's good to see that you've stayed for the last session today. So, on annuities, so Fidelity has been writing annuities for the last 30 years, but we write a very small amount of annuities in a very small market. But we are the only provider in the New Zealand market. So, I've had to do a little bit of extra research just to see what's happening overseas. So I have relied on the OECD report number 24 on annuities, and also on a Swiss Re presentation that was done to the actuarial conference in Sydney this year. So the OECD summarised New Zealand. New Zealand also has a very small annuity market, though in contrast to its counterpart across the Tasman Sea, this is primarily due to the very low levels of private pension savings resulting from the comprehensive social security and absence of tax incentives. So, there is a very low demand for annuities in the New Zealand market, and some of the things are sort of pointed out there. Obviously, we don't have a lot of defined benefit schemes in New Zealand, so there's not the flow of annuities out of those defined benefit schemes. We've also got a very generous New Zealand superannuation, so people see they're already getting a pension, they don't want to buy another pension. And then we talked today about the tax disincentives of KiwiSaver. Well, the tax disincentives of annuities is worse than KiwiSaver. So hence, those three things really add up to quite a lack of demand in the New Zealand market. But there's not a simple solution to this. So it's not about going out and fixing the taxation of annuities. This is really a bigger story. And I think we've made, pretty good progress on the accumulation phase of superannuation, and we've obviously talked about that today. KiwiSaver obviously is a fantastic tool in that accumulation, subject to the few tweaks that we talked about today. But New Zealand is also great at the family home, and a lot who get to retirement age 65 will look to downsize those houses. So they'll look to sell the 3-bedroom or the 4-bedroom down to the 1-bedroom home and release capital in their retirement years. And then you've got the sale of the sale of the business or of the family farm. So from there we've built up a pretty good estate, but the big issue is how we're going to spend that money, and as a nation, how we want that money to be spent. Now, we talk about annuities, and do we really want all that money to go into annuities? The issue with annuities is most providers of annuities will put that money into long-dated bonds. There will be a little bit of equities, but predominantly that will go into long-dated bonds. Is that really what we want for our nation? So do we want instead to invest in the New Zealand share market, into the Meridians, the Mighty Rivers, the Air New Zealands, into our ports, our rail systems, etc.? Do we want to invest overseas? We see Australia looking to invest more of their superannuation funds overseas. Do we want to invest in the property market, into the Auckland housing market, to improve the price of my house? There might be some good reason for that. But we also probably want a little bit of consumption. We need the country to keep moving along. So how much do we want to spend on the car, the new car, the travel overseas? How much do you want to spend on the boat to go out fishing on the Waitemata Harbour to get your 3 snapper? And how much do we want to put in finance companies? Well, we definitely don't want to put money in finance companies, and I know Dr. Coleman spoke today about how, you know, the con men ripping off the old people and stuff like that. So, you know, and also I'd mentioned David Ross in that sort of category. So we obviously need protection around that decumulation process to make sure that the investments go into the right area, and also we need education around that process as well. So I was asked to answer a couple of questions today. Why are we exiting the annuities market? And probably the principal reason is there is no market in this country. Over the last 12 months, we've probably done 1 quote a month. And from those 12 quotes, we got 1 sale. And that was sold to a 95-year-old who basically, I think he was an actuary, I'm not sure, but he's bet on the basis that he can live longer than our mortality tables, and I think he's actually quite correct, and we'll probably lose money on that one as well. But we you know, we've been in it for 30 years, and we were happy to continue on giving annuities as a sort of a community service. We had a monopoly situation, so, you know, there was no pricing pressure on us at all. Whenever there was a debate about annuities, we got free advertising, and whenever there was a conference, we got invited along to talk about it. So there were quite a few positives in keeping it going, but we've come to a point now, the new requirements by the FMA to basically change your prospectus and investment statements into plain English means that we probably need to spend in external legal costs around 30 to 50,000 to bring it up to that standard, plus all the internal costs means it just doesn't make economic sense to continue with annuities. The other point I'd like to point out that there's a real reluctance by directors to sign a prospectus if they don't have to. Now, we used to have to sign 9 prospectuses a year, so we got it down to 2 now, and our directors are a lot happier at that. So New Zealand is not alone in this annuity issue. It's a real worldwide problem. In the UK, in the 1970s, there were 100 providers of annuities in the market. That is now down to 20. In Australia, there is only 4 providers. In New Zealand, by Christmas, we will be down to 0. And this is a little bit of a reflection of, you know, annuities are really not that popular. It is a diminishing market. In the UK, where annuities are compulsory and they're moving to these lifetime benefits, they did a survey recently, and 58% of people who took annuities said we would have rather taken the lump sum and invested it ourselves. So not popular around the world, and also what we're seeing is there's a big shift away from the risk from the providers of these annuities to the annuitant. So the old traditional annuity, which I'm talking about, so you give me, say, $500,000, and then I give you an income for life until you die, or possibly even your spouse's dies, is there a traditional annuity where we, the provider, takes the risk of basically mortality and the market risk. But now we're shifting to these, as they call them, programmed withdrawals, where now the annuitant is taking the risk of living too long. If they live too long, then they're going to run out of money, or if the market crashes, they're also going to run out of money. And that's a big shift is happening like that right throughout the world. So, what will it take to get Fidelity back into the annuity market? Well, the New Zealand public failed to get Buck Shelford back into the All Blacks, and I think the chances of getting Fidelity back into the annuity market are going to be quite similar. And it's purely these reasons. There's really not a demand. It is a diminishing product around the world, so why would you invest into that area? You've got to realise as well that over the last 20 years, life insurance companies have lost a lot of money, millions and millions of dollars on annuities, because when they sold annuities in the 90s, they didn't factor in mortality improvements, and we've been absolutely hammered over the last 20 years. In the 1990s, they never factored that interest rates would get down to 0 or 2%. I can remember in the 80s we were quoting tax-paid returns of between 12 and 15%. So you can imagine how much money we lost on those annuities from back then. Obviously we need to address the taxation issues. The other thing is the regulatory framework needs to be right as well. So if we write around $1 million of annuities, we have to raise around $200,000 of capital to manage those annuities. So that needs to be factored into the price as well. We've got the longevity risks, so we've seen what's happened in the last 20 years. What's going to happen in the next 30 years? How can you predict what's going to happen to people in terms of their mortality rate over the next 30 years? And then you've got to try and get something to offset that risk, and there's not a sufficient financial instruments in the market to offset that 30-year risk. So what I've done today, I haven't given you any answers at all. I've just given you a whole lot of problems. I'm just saying that really to solve the decumulation problem, so it's late in the day, it needs a lot more research, it needs a lot more debate, and we need to make sure that we come up for the right solution for New Zealanders. So the two people who do have the solutions are right next to me, and we will hear from them now.